Guys, it's Patrick Portman, certified financial planner here in Bardstown, Kentucky, and owner of Portman Wealth Management. I've really enjoyed these videos. It's a little different than my routine for the day, but it's good to break things up and hopefully educate some individuals about topics that us as financial planners help clients with every day. So we're going to tackle a topic that is no one's favorite, but it's part of our life. It's taxes. So once again, I focus on helping individuals from 15 years or less approaching retirement. So these videos are going to be geared to individuals kind of in their 50s or small business owners. I focus on them as well. So I hope this helps give you a simple understanding of taxes and how financial planners help individuals in retirement with taxes. Keep in mind that I'm not a CPA. I don't offer tax advice individually as far as filing tax statements or returns for individuals, but it's important for all advisors to understand taxes and how it affects my arena in helping clients to be able to help them and their CPA. So, taxes in retirement. A lot of my clients come to me and say, how is my Social Security and taking money out of my IRA going to affect taxes? And before we can get into that, we need to understand how taxes work. So really right now we're in a very low tax environment historically, which is great. It's allowed some of my wealthier clients to take advantage of different strategies, which we will talk about, and just helped us all as far as having a higher standard deduction, paying lower overall taxes. Now, that may change as our life goes on, as your retirement goes on, but all we can do is focus on current environment, utilize what we can, and then as changes come down the road, it's our job to help clients navigate those changes. So here's just a demonstration. There's actually 7 different tax brackets currently. These are the top, or the first 3 brackets for a couple married filing jointly. So that would be like myself and my spouse. The money we make, here's the federal tax system we pay into. Now, a lot of my clients actually have a misconception of telling me, Patrick, I don't want to make any more money. I don't want to jump into that next bracket. I understand that, but I want to help alleviate that fear a little bit. So the tax system's tiered, meaning that each amount we make is taxed at a different rate. So the first $19,750 all Americans make is taxed at 10% no matter what. So a client coming to me and saying, Patrick, I don't want to make that extra dollar, they need to realize that in this scenario, if a client had a tax bracket or a tax return where their taxable income was $19,751, only that extra dollar over that amount will be taxed at this new rate. So there's no reason to worry about not making more money just because of jumping into that next tax bracket. That's a big misconception. I think people in their minds think, well, if I make $80,251, now all of that is taxed at 22%. And that's just simply not true. So it's important to understand, as professionals helping clients, working with their CPAs, how the tax system works. And that's a big misconception a lot of people have. Patrick, I don't want to take more money out of my IRA because I'll jump into a next tax bracket. Yes and no. So hopefully that alleviates a little bit of fear of, yes, we may jump into another bracket, but only the amount over this amount will be taxed at the new rate. A great thing in the state of Kentucky is we're not taxed additionally on Social Security, and the first $31,000 we take out in this state from IRAs, pensions, annuities are not state taxed as well. So Kentucky has some favorable retirement income tax savings. Now, Social Security is a totally different conversation. Yes, Social Security is taxed at certain breakpoints. Today, we're going to focus on IRA distributions, but do realize as a financial planner, and maybe that'll be another video, of Social Security is taxable. And there's certain rules around Social Security, but I think it deserves its own video just because of the complications. In this scenario, a client coming to me and saying, Patrick, I need $5,000 a month to live the life I want. We're going, alluding to the last video, help figure out taking money from their IRA, using Social Security, using any pensions to navigate that $5,000. A big thing people don't think about, they may come in with a $750,000 IRA or 401k that we start to help them with, which is great. But what they don't think about is none of this money, if it's just in an IRA or traditional 401k, has been taxed. So when we take each dollar out, we will have to pay federal and possibly state taxes on that money. And that's nothing to be concerned with. It's just we need to realize that if a client needs $5,000 a month to do the things they want, myself as an advisor, I need to take out more than that, maybe $7,500, maybe $8,000, and let the excess go towards paying taxes and have the $5,000 go to the client. So remember that just because we have saved all of this money in a pre-tax structure, which most individuals have, remember that every dollar we pull out, we will pay taxes on. Now that goes into my next thing that I cannot tell clients enough. If we're still working, and we'll talk about some strategies around this as well, but if we're still working, if our company offers a Roth 401k, please, please, please utilize it, and here's why. When it becomes the distribution phase, every dollar we take out of IRAs or 401ks, so that's just traditional IRAs or 401ks, is taxed. Everything we take out of a Roth IRA or Roth 401k is not taxed at all. So a client needing $5,000, if they had a $750,000 Roth IRA, well then we could just take out exactly what they needed. We wouldn't even have to worry about taking any money out to go to the federal tax system. My perfect client has money in 3 different buckets. They have money in traditional IRA, traditional 401k, as we mentioned here. They have a Roth bucket, and then they also have just individual investments or savings. And we work together to pull out each amount to meet their need and keep that tax bracket as low as possible. So don't worry if you've worked your whole life, you have a sizable traditional IRA or 401k. It's okay that we don't have this, but just know, that is the ideal situation, is to have those 3 different buckets. As we take money out of this IRA, remember that each dollar is taxable. So it's not taxed in a special way. I try to frame it to clients that if I take $40,000 out of an IRA per year, think of it as I made $40,000 working the job that I retired from. It's no different. We're going to pay ordinary income tax on traditional IRAs and traditional 401ks. So it's going to use the framework that we've demonstrated here, $40,000. If we took out, let's just assume for this example that $40,000 is our taxable income, we're going to fall in here. First $19,750 is going to be taxed at 10%. Everything else is going to be taxed at 12%. So it's no different. We retire, we start pulling money out of an IRA or traditional 401k, we're going to be taxed in the same exact pattern as us working and making $40,000 a year or whatever we pull out. Another topic that is super worrisome and important when clients come in here is, what are RMDs and how do they affect me? The tax code just changed a couple years ago that at age 72, individuals are forced to start taking money out of their IRAs and 401ks, and that amount is determined by the IRS. So we hit 72, we have X amount in traditional IRA or traditional 401k savings, the IRS is going to make us take out a certain amount per year from then all the way until we pass away. And actually, even when it hits the next generation, they will still have to pay taxes on it. That's another conversation, but Uncle Sam is going to get their piece of the pie. My job and your CPA's job is just to make sure they don't get any more than they deserve. So RMDs do occur at age 72. My job is to help realize that that's coming down the road. If we can create strategies to minimize what we're going to have to take out, then we're going to do that. Usually affects my wealthier clients because maybe they had real estate, rental property, non-qualified investments, Roth IRAs that they're using to create their monthly income, but their big traditional IRA or 401k is still ballooning. At age 72, the federal government's going to make them take out a lot, and it may, in fact, bump them up and force them to be in a different bracket than they were originally thinking they were going to be in. So there's a lot of strategy around knowing RMDs are coming and figuring out how do we minimize the tax implications of those. Third thing is some tax strategies around retirement investment. So a big thing that I've focused on in this low tax environment is what I call filling up these low first two tax brackets. The tax system could change tomorrow. We just don't know. The fact that we're in the lowest environment in several years, or history for that matter, I try to get my clients to utilize these low brackets and do what's called a Roth conversion. So let's say that a client made $40,000. In this scenario, there's still almost another $40,000 that they could take out of their IRA, put into a Roth IRA, which is a Roth conversion, and then let that money start to grow and earn earnings that won't be taxed. So it's a little complicated when I mean filling up the tax bracket, so to speak, but in this sense, what I'm banking on is if we're at the lowest environment ever, taxes are going to go up. So let's take advantage of these low brackets while we can, because maybe 5 years down the road, the lowest two brackets could look, 10, 15, this could change to 25, who knows? So our job as the tax environment changes is to help our clients navigate, save as much as we can on taxes, and let those investments work to grow long-term wealth. Now, this is just scratching the surface of taxes when it relates to retirement and retirement income. But I do feel like these were three pain points. Clients just didn't know how taking money out of their investments affected their taxes. In this scenario, look at it directly like you working, making $40,000, $50,000, whatever you take out, and then paying Uncle Sam the same way. RMDs, age 72 is when we're forced to start taking money out of those traditional IRA strategies. And then 3, working with the financial planner, letting them assess your situation and find opportunities to work with your CPA to save you on taxes. Hope this has helped. Taxes are a gamut of their own, but it's vitally important for us as CFPs to understand them, work with the client's CPA, and help them minimize that tax situation. As always, ask me anything. I hope this has provoked some questions and helped clarify at least a huge misconception here of jumping up a tax bracket. I hear that a lot. But until next time, I appreciate all the viewership, and I hope you guys have a great rest of your week. Thank you.